Birkenstock flip-flop stumbling double digits in an underwhelming Wall Street debut, leaving it $1.7 billion shy of its original target valuation.
Coming up on the show, Birkenstock loses its footing. I've got to be honest, our producers are just loving the foot fest of puns that is happening on this Birkenstock listing. Anyway, shares slide in its long-awaited IPO. We'll get Annetta to join us with the details after the break up.
Birkenstock shares dropped over. I'm just distracted by Steve sitting here with, preparation for...
I beg your pardon?
Doing some preparation there?
I was doing some preparation for the next segment, yes.
Yes, Birkenstock yesterday.
Birkenflop.
Birkenflop. We've had a few...
Didn't flip-flop, it just flopped.
It was an ugly start, ugly debut.
Well, apparently they're beautiful shoes now. They've had a reinvention.
Too many exposed toes.
Oh.
There have been so many puns around this one, right? And the Birkenstock shares dropped over 10% in their market debut stateside. The worst first US IPO performance for a company worth over $1 billion since 2021. The shares were priced in the middle of the indicated range at $46, valuing the company at around $9 billion. Speaking to CNBC, the CEO, Oliver Reichert, has defended the company's valuation.
The track record I've created in this company since 10 years is 20% CAGR, 60% gross profit margin, and 30% plus X EBITDA margin. Okay, you show me any comparison to this, and then you really have to dig deep into the luxury segment to come up with a comparison. So, yes, we are very confident, and yes, our estimation for the future and the forecast is always a bit more traditionally oriented, but
conservative.
The insiders know.
Under promise, over deliver.
You got it.
Our next guest, who is Matt Oguz, the CEO of Iris Family Office. Matt, you're flagging up to us yesterday that there was a lot of interest that had been flagged from cornerstone investors, which potentially boded well for the company. But ultimately, investors did not want to slip into these so-called comfortable shoes. They didn't feel as though there was a natural fit with Birkenstock. What happened? What went wrong, do you think?
Good morning. Thank you for having me. So looking back, even before Birkenstock hit the scene, we noticed a pattern. Both the companies involved and their underwriters seemed to gravitate towards a handful of major cornerstone investors, essentially sidelining a broader group, which includes investors, institutional investors like hedge funds and family offices. Now, the inherent risk with leaning on a smaller group of large investors is that you might miss out on the broader support needed once the stock begins trading. So that's the exact scenario that played out for ARM, Instacart, and Klaviyo. And regrettably, we saw the same narrative unfold for Birkenstock today, with their stock opening a notable 10% below the anticipated IPO price and way late in the day as well.
No doubt there's some investors that were looking at the news from LVMH yesterday about what they saw in those numbers from the bellwether in the luxury space. Now, Matt, I want to ask you, too, about the direct-to-consumer model. This has been a big one that a lot of retailers have sought to build out themselves, that gets them away from the discounting models and some of the uncertainty around big department stores and other retailers. Why is this key, and how does an investor think about valuing a direct-to-consumer model?
Yeah, I mean, the direct-to-consumer model obviously is key because you go direct to the purchaser, you go direct to the consumer, and you're eliminating all of those intermediaries, and essentially you quote-unquote own the consumer in that regard. So you know what the consumer's needs are, and you know when they're on your website what they're looking at, what they're browsing. So that gives you unprecedented opportunity to cross-sell, upsell, discount, run programs, and all sorts of things to lure and sell to that consumer, as well as keep the consumer coming back to you. And so it's very important for all luxury brands and essentially all brands to go direct to consumer, which isn't really that hard to do by way of e-commerce today.
Matt, really good that you could join us from San Francisco. Look, I'm going to go back a stage to your first answer with my colleague Karen as well. It is bonkers for a stock in this market to be priced at 30 times plus when actually its USP is it's questionable. It is a shoe company. It is not a creator of GPUs. It is not an NVIDIA type company that has explosive growth in AI. What's going wrong with people's valuations? Are we just getting greedy?
I mean, look, Birkenstock's a 250-year-old company, and there aren't that many of them. They bring with it a strong brand legacy, a vast loyal customer base, and an iconic product range. And these intangibles can command premium valuations. So when benchmarking against industry peers, some companies in the consumer goods and luxury sectors have garnered similar, if not higher valuation multiples if they have a strong brand and growth trajectory. So it's not just looking at today. I mean, it's very rare to see a product like Birkenstock, a name like Birkenstock, emerge from private and now come to the public realm and make an offering to public investors, both institutional and retail. And so with that, the premium may not be so outrageous, but what was really disheartening today and over the last 3 IPOs, in fact, the ones that I named earlier, is the selection of cornerstone IPO investors within the process of the IPO itself, rather than a broader base of institutional investors. And so that's sort of.
Sorry, Matt, I'm struggling. I know that we're making a market here between us, but I just don't buy it. I mean, I look at one of the biggest footwear companies in the world, albeit a different company. Nike trades on 24 times as well, and they can ride out any storm because of their scale of products as well. Then I look at the luxury goods sector, and the premium names, yeah, they trade at 35, 40 times, but the average of the sector trades between 13 and 20 times going forward on a forward PE. Buying a stock trading at 30 times plus with a sales multiple of 5 times as well. I get it, it's a 249-year-old company, but I mean, it doesn't deserve that kind of premium to illustrious names in the sector, does it?
6 times the sales multiple, actually, if I'm not mistaken. These are rich valuations, by all means, but when you combine the brand versus, you're not looking at just what the brand could deliver today, but what the brand could deliver tomorrow and the day after and then thereafter. And so, essentially you don't really see a lot of brands like that. So from, if you split the investors into 2 different groups, from an institutional investor's point of view, these are groups that work to deploy large sums of capital into these companies. There aren't that many choices out there to go after. And so when you combine all of those elements together and the future potential and a 250-year-old name, it appears to be a bet that many investors were willing to make. Now, in this case, even 3 large investors came in, and they're even mentioned in the prospectus. And so large institutional appetite was certainly there, but I feel like the company during the allocation process, as I mentioned before, I know I keep going back to the same point, but to gain the support to sort of markets are very anxious these days. And so, what happens on the first day or the first 2 weeks are kind of important to me. Now, the numbers will play themselves out. We'll see in their earnings calls this quarter, next quarter, and the years after that. So we'll see how that all fares. But the first 2 weeks, first 2 to 4 weeks are very important if we have more companies essentially lined up to go public.
Matt, great to get your view, and it's nice to create a market as well. Thank you very much indeed for that, and thanks for joining us at, I don't know what time it is in San Francisco, but I'm sure it's pretty late. Thanks, sir. Matt Oguz, who is CEO of the Iris Family Office.